Gold just crossed $5,387 an ounce in a single session, and the mainstream financial media is calling it a safe haven spike. But that explanation is hiding something far more important, something that could reshape your portfolio for the next 12 months. Welcome to Capital Anchor. I cut through the noise and show you what is actually happening in markets while everyone else is distracted. If you are new here, subscribe right now because what I am about to show you goes far deeper than one conflict. On February 28, 2026, the United States and Israel launched coordinated strikes on Iran. Israeli aircraft targeted Tehran's command infrastructure and air defense systems. Then came the news that stopped markets cold. Iran's supreme leader, Ayatollah Ali Khamenei, was killed. That had not happened in 46 years of the Islamic Republic's existence. Within hours, spot gold surged to 0.1% to $5,387.55 per ounce. U.S. gold futures climbed to 0.8% to $5,394.91. That single-day move added over $200 per ounce in real dollar terms. The Dow Jones dropped 1.3%. The S&P 500 fell 0.4%. Nasdaq slid close to 1%. And oil markets began pricing in the worst-case scenario. Now here is what most people are completely missing about this move. Everyone is calling this a geopolitical spike, a knee-jerk reaction, something that will fade in 48 hours. That is what they said in 2022. That is what they said in 2019. They were wrong then, and here is why they are likely wrong again. Think about a pressure cooker sitting on a stove. You can turn the heat up slowly for months, and the pot holds, the lid rattles a little. You adjust. But the moment you remove the pressure valve entirely, the release is not gradual. It is sudden and explosive. Gold had already surged 64% in 2025 alone. That pressure had been building for over a year. The killing of Khamenei was not the cause of this move. It was the pressure valve being removed. This is reason number one. Gold was already being repriced by institutions before this conflict escalated. Central banks in emerging economies had been accelerating their gold purchases throughout all of 2025. The World Gold Council confirmed that geopolitical instability and U.S. fiscal risk were the two primary drivers. Bank of America analysts estimated that central bank gold holdings now represent nearly 18% of outstanding U.S. public debt, up from 13% just a decade ago. That is not a reaction. That is a structural shift in how the world's largest institutions view dollar-based assets. Reason number two. The Strait of Hormuz has entered the equation. More than 14 million barrels of crude oil per day flow through that strait, roughly one-third of the world's total seaborne crude exports. One-fifth of global liquefied natural gas also moves through it. Multiple oil majors and major trading houses have already suspended crude oil and fuel shipments through the Strait of Hormuz. Iran has publicly stated it has closed navigation. That is not a warning, that is an action already taken. When the world's most critical energy choke point closes, inflation expectations rise everywhere simultaneously, and the asset that historically performs best in that exact environment is gold. Reason number three. The U.S. fiscal backdrop was already bullish for gold before a single bomb dropped. Bank of America analysts noted last week that regardless of how Congress rewrites the budget bill, U.S. deficits will remain elevated. Their analysts went on record saying, and this is critical, that the fiscal fallout may ultimately be a bigger driver for gold than the conflict itself. BofA had a $4,000 price target on gold before the strikes. Now analysts at J.P. Morgan and Bank of America are both reiterating the $6,000 level as a realistic target. Now here is the disconnect that most retail investors are completely blind to. While retail investors are watching conflict headlines and debating whether gold will pull back after the spike, institutional players have been positioning since mid-2025. The average investor has allocated just 3.5% of their portfolio to gold, according to Bank of America's data. Meanwhile, central banks, the biggest players in the room, have been buying at the fastest pace in decades. While you were watching stock market all-time highs in 2025, they were quietly converting dollar reserves into physical gold. While mainstream media told you gold was overbought, sovereign wealth funds and central banks were treating every dip as a buying opportunity. Kyle Rada, senior market analyst at Capital.com, said something important this week. He stated that unlike previous escalations, both sides now have strong incentives to continue escalating. And that creates the risk of a chaotic, volatile environment lasting far longer than a few days. That is not a retail investor talking. That is someone who watches institutional money flows for a living. The mainstream narrative right now is, wait for the conflict to calm down, then reevaluate. That is exactly what retail investors said in early 2022 before gold began its historic run. The institutions are not waiting. They never do. But here is what almost no one is talking about, and it changes everything about where gold goes from here. Go back to June 2025. Israel struck Iranian nuclear sites. Markets sold off sharply at the open. Then they recovered within days. Most retail investors breathed a sigh of relief and moved on. That was the moment institutions began accelerating their positioning. While retail celebrated the recovery, central banks and sovereign wealth funds used that dip to add significantly to physical gold holdings. Historical data shows gold averages 8.98% gains over 12 months following the start of geopolitical conflicts. Not a short spike, not a 48-hour move, a sustained 12-month repricing. This conflict is structurally different from June 2025 because this time, Khamenei is gone and the Strait of Hormuz has already been partially disrupted. The pattern is not new. During the 1970s oil crises, gold moved from $35 to over $800 per ounce. The mechanism was identical: energy disruption feeding inflation expectations feeding safe haven demand feeding a sustained gold repricing cycle. We are inside that same mechanism right now. The ignition already happened on February 28, 2026. Now here is what has not changed: the structural foundation that was already in place before a single strike was launched. Central bank gold purchases totaled 863 tons in 2025 and are expected to stay near 850 tons in 2026, maintaining a structural floor under prices. That floor does not disappear because of a diplomatic headline. It is the foundation of the long-term thesis. The silver market is expected to remain in deficit for the sixth consecutive year in 2026. Silver is not just following gold. It is being driven by its own industrial demand cycle: solar panel capacity, electronics manufacturing, and structural supply shortfalls simultaneously. Safe haven assets including gold, Swiss franc, yen, and U.S. Treasuries are gaining as investors reduce risk exposure, while defense stocks benefit from rising military spending, and tariff uncertainty adds another layer of volatility to global markets. This is a multi-vector environment. Gold is not just reacting to one thing. It is reacting to everything at once. U.S. deficits remain elevated regardless of how the Middle East situation resolves. The dollar's credibility as the world's sole reserve currency continues to erode. Those structural drivers were in place before February 28. They are still in place today. Now I am going on the record. Screenshot this. Gold price forecast models project the metal will reach $5,496 per ounce by March 7, 2026, an additional 4.14% gain from current levels if the geopolitical situation does not de-escalate. I believe that target gets hit. But more importantly, I believe $6,000 per ounce gets tested before the end of Q2 2026. Analysts now forecast potential targets of $5,500 to $6,000 per ounce if hostilities intensify further. That is not speculation. That is the consensus of institutional research desks right now. And those desks do not publish targets they do not believe in. My on-the-record call: gold reaches $6,000 per ounce by June 30, 2026. That is a 12% move from today's levels. The Strait of Hormuz situation is the accelerant. The structural demand floor is the engine. Now let us talk about scenarios with real probabilities. Scenario 1: conflict is contained within 4 weeks, the Strait of Hormuz reopens fully, and diplomatic channels stabilize. If the conflict is short and contained, the risk-off move and oil spike could be brief. In this scenario, gold pulls back to the $5,000 to $5,100 range before finding support and resuming its uptrend. Probability: 30%. Scenario 2: conflict extends 3 to 5 weeks with ongoing Hormuz disruption and oil pushes above $80 per barrel. If the Strait of Hormuz continues to be disrupted or military responses persist, it is likely that oil and precious metals will continue to move higher while global equities feel renewed pressure in this scenario. Gold tests $5,800 to $6,200 by May 2026. Probability, 55%. Scenario 3: conflict escalates beyond Iran into a wider regional war involving proxies across the Gulf. In this scenario, gold moves above $6,500 before any meaningful pullback. Probability, 15%. Now, practical takeaways segmented by who is watching. If you are holding physical gold already, do not panic sell into strength. Financial advisors commonly recommend 5 to 15% allocation to precious metals, but the current conflict has prompted many strategists to advocate for higher allocations, particularly for investors concerned about systemic risks and currency debasement. Your position is not a trade, it is insurance. Treat it that way. If you are actively trading or using leverage, understand that volatility is a two-way weapon. For a retail investor, the practical message is that oil is a volatility asset during geopolitical stress. You can be directionally correct on risk and still lose money if you enter at the wrong moment because a diplomatic headline hits, and the premium evaporates. The same applies to leveraged gold positions. Size carefully. A single ceasefire rumor can erase a week of gains in 1 hour. If you are sitting on cash on the sidelines right now, the window to enter at a reasonable risk-reward ratio is narrowing but not closed. A pullback to the $5,100 to $5,200 range would represent a strong structural entry point based on where central bank buying activity has historically stepped in. Watch for that level, do not chase the spike. If you bought at the top and are sitting on unrealized losses from higher in the cycle, understand this: the long-term thesis has not broken. If anything, it has just been reinforced by a new set of structural catalysts. Your entry was early, not wrong. Here is what to watch going forward. Watch the Strait of Hormuz. Marine tracking sites are already showing tankers piling up on either side of the strait, unable to get insurance for the voyage. The moment those tankers start moving freely again, risk-off pressure will ease and gold may consolidate. Watch the DXY, the US dollar index. If the dollar strengthens significantly, gold may face short-term headwinds even in a risk-off environment. Watch COMEX inventory levels. A drawdown in physical COMEX gold stocks would signal institutional demand accelerating beyond paper market capacity, and watch US CPI data. A prolonged increase in oil prices would raise inflation expectations and make financial conditions more severe for the world's economies. The next CPI print will tell you how much of this energy shock is already being priced into the broader economy. Now let me tell you about the 3 types of people watching this video right now. The first type is panicking. They are refreshing their portfolio every 20 minutes, thinking about selling, worried they missed the move, and consuming every negative headline they can find. They will make emotional decisions. They usually sell at exactly the wrong time. The second type is frozen. They see what is happening. They understand intellectually that gold is moving, but they cannot bring themselves to act. They are waiting for certainty. Certainty never comes in markets. By the time certainty arrives, the move is already finished. The third type is learning and preparing. They are studying the mechanism. They understand why this is happening, not just that it is happening. They are building a framework that they can apply the next time because there will always be a next time. Markets do not destroy wealth, they transfer it. Wealth moves from the impatient to the patient. From the uninformed to those who understand the mechanism, from the people reacting to the headline to the people who already understood the structure before the headline was written. Today's session proved exactly that. Gold was already at $5,100 before a single strike happened. The institutions already knew. The central banks already knew. The structural bet was already in place. The February 28th headline was not the beginning. It was the confirmation. That is exactly what I told you in the beginning of this video. One event, one pressure valve removed, and a move that most people are still calling a temporary spike. If this gave you a sharper understanding of what is actually happening and why, hit that like button right now. Subscribe to Capital Anchor because this is the kind of analysis I deliver every week while mainstream media keeps you distracted with noise. Share this with someone who is watching their portfolio right now and feeling confused about what to do. They need to see this. Drop a comment below and tell me, are you buying the dip or waiting it out? I read every single one. This video is for informational and educational purposes only. It is not financial advice. Always do your own research before making any investment decisions.